Hi, we are in a new chapter, Nature of Goodwill and Valuation of Goodwill. In this section, we will discuss the introduction to this chapter, covering various topics under the head Nature of Goodwill. This particular video will focus on meaning of goodwill, definition of goodwill, and the features or characteristics of goodwill. Let's begin with meaning of goodwill. When we refer to goodwill, we are talking about that element which puts the organization in an advantageous position, due to which this organization is able to earn higher profits without putting in extra efforts. To give you an example, a certain enterprise may be put in an advantageous position. Why? Because it has rendered good service to its customers. And obviously, the satisfied customers keep coming back to the same enterprise, and this will enable the enterprise to achieve higher sales and therefore higher profits. So this is an example of goodwill enjoyed by this particular enterprise because it renders very good service to its customers, and therefore the satisfied customers keep coming back to the enterprise, leading to higher sales and higher profits. Next, let's go into the definition of the term goodwill. Goodwill is the present value of expected future income that is in excess of the normal return on the investments in tangible assets. There is an alternative definition. Goodwill can also be defined as the excess of price paid for a business as a whole over the book value or computed or agreed value of net tangible assets purchased. There's a third definition by Dixie. When a man pays for goodwill, he pays for something which places him in the position of being able to earn more than he would by his own unaided efforts. We've seen the definition of goodwill. Let's go into the features or the characteristics of goodwill. First feature, goodwill is an intangible asset. Therefore, it has no physical existence and cannot be seen or touched. So now, while we are in this topic, let's understand the difference between what is called a tangible asset and what is called an intangible asset. A tangible asset. Before that, let's revise what's a fixed asset. A fixed asset is something which is not for sale, but it will help the firm earn profits. A tangible fixed asset is an asset that has physical existence. It can be seen and touched. Examples of tangible asset include land, building, plant and machinery, furniture, office equipment, motor vehicles, etc. Next, let's see what an intangible asset is. An intangible asset is an asset that has no physical existence. It cannot be seen or touched, but it will help the firm earn profits. So examples: Apart from goodwill, patents, brands, trademarks, copyrights, franchises, license, etc. are examples of intangible assets. Let's go to the second characteristic of goodwill. Goodwill has no existence separate than that of the business. That is, goodwill will have realizable value only when the business is sold. You cannot sell the business separately and goodwill separately. Goodwill is attached to the business. There is no goodwill without the business. What is the realizable value of goodwill? This value of goodwill is subjective. It depends on the assessment of the valuer. There are different methods of calculation of goodwill. There is no specific amount which can be attributed to this goodwill. That is why it is said that the value of goodwill is subjective. It depends on the assessment of the person who is valuing the goodwill. Third characteristic, goodwill enables the enterprise to earn higher profits. And what's the reason? Since the customers are satisfied with the business, it could be because of good quality of products or good service which is given to customers. Therefore, they keep coming back to the same business and it helps the business earn higher sales and higher profits. Therefore, goodwill is an attractive force which brings the customers regularly to the business. The fourth characteristic of goodwill, goodwill may arise due to brands, trademarks, patents, market reputation, etc. Fifth characteristic, what is the meaning of goodwill in the context of sale of business? We can explain this by means of an example. What is goodwill in context of sale of business? Now let's say both A and B are interested in running a restaurant catering to local customers. Let's say B sets up the restaurant from scratch, whereas A decides to buy Z's restaurant, which has already established a name for itself in the same area or locality. Therefore, though B struggles to set up the business and attract customers, A will start making profits from day one. Why? Because of the goodwill which is already earned by Z in his restaurant. The local customers are already familiar with Z's restaurant. So from the first day, A will get customers. Now, therefore, A should compensate Z for the excess profits earned by him due to the goodwill created by Z. Such excess profits which B could not earn as he had started his own restaurant from scratch. Now the compensation which is paid by A to Z is referred to as goodwill. Next point. Now, what is the meaning of goodwill in the context of partnership accounts? Goodwill in the context of partnership accounts refers to the share of profits which is sacrificed by the sacrificing partner. Now, who is a sacrificing partner? When there is a change in profit sharing ratio among the existing partners, one or more partners may sacrifice their share of profit in favor of another partner. So the partner who sacrifices the share in favor of another partner is referred to as a sacrificing partner. This is in the case of change in profit sharing ratio. Now let's say there's an admission of a partner. Now one or more existing partners will sacrifice their share of profit in favor of the incoming partner. So the incoming partner never had any share of profits. So now that he is getting a share of profits, one or more of the existing partners have to sacrifice their share of profit, and such partner is referred to as a sacrificing partner. Now when a partner retires or dies, the retiring or deceased partner will sacrifice his share of profit in favor of one or more continuing partners. So in this case, the retiring partner or the deceased partner is the sacrificing partner. Now we'll understand goodwill in the context of partnership accounts. The goodwill of the partnership firm was created when the partners were sharing profits in a certain old profit sharing ratio. Now, if as a result of change in profit sharing ratio or even admission or retirement or death of any partner, if any particular partner loses or sacrifices his share of profit in favor of another partner, then the partner who loses this share of profit, called the sacrificing partner, has the right to be compensated for the share in the profits which has been sacrificed by him. Now the reason is, this is because at the time the efforts were put into the business, the partners were sharing profits in the original ratio. So the goodwill was created when the profit sharing ratio was the old ratio. So as a result of a change in profit sharing ratio, admission, retirement or death, if any partner sacrifices his share of profit in favor of another partner, then such sacrificing partner has a right to be compensated by the person who is gaining or gaining partner. We understand this by means of an example. Let's say A and B are equal partners in a firm whose goodwill, which is the excess of profits earned by this particular firm of A and B over the normal profits earned by other firms in the same industry, is valued as rupees 50 lakh. Now in case of sale of business, let's say A and B decide to sell their business to Q. Q will have to compensate A and B for the book value or the agreed value of net assets of the business which is taken over by Q plus rupees 50 lakh, because the goodwill of the firm is 50 lakh and Q buys the entire business. Now on the other hand, when there is a change in profit sharing ratio between A and B, due to which A gains 1 by 5 and B loses 1 by 5 of the profits. Now the sacrificing partner in this case is B and the gaining partner is A. So A, who will start earning profits, extra profits of 1 by 5th of 50 lakh, which is 10 lakh, will have to compensate B, the sacrificing partner, by 1 by 5th of 50 lakh, which is 10 lakh. Because the goodwill was created at the time when the profit sharing ratio between A and B was equal. The seventh point, goodwill is an intangible asset and not a fictitious asset. So what's the difference between an intangible asset and a fictitious asset? Both intangible assets and fictitious assets have no physical existence. However, whereas an intangible asset has a realizable value a fictitious asset has no realizable value. That is, when you sell an intangible asset, you can get money, whereas you will not get any money if you sell a fictitious asset. Let's go to the 8th point. Goodwill is amortized over its useful life. Let's understand the difference between the term depreciation and amortization. Writing off of fixed tangible assets over its useful life is called depreciation. On the other hand, writing off of fixed intangible assets over its useful life is referred to as amortization. So we've learnt about the characteristics of goodwill. Now in point 5 and point 6, where we learnt about the concept of goodwill in the context of sale of business and concept of goodwill in context of partnership accounts. It is not really a characteristic. It is just so that we can understand the concept and relate to the meaning of goodwill at the time when the whole business is sold and at the time of reconstitution of partnership, when there may be a change in profit sharing ratio, admission of partner, retirement of a partner, or death of partner. So in this video, we covered the meaning, definition, and the characteristics of goodwill. In the upcoming video, we will have a look at Accounting Standard 26, which deals with goodwill, and also have a look at the need for valuation of goodwill.